Hey investors! Welcome back to Novice Investing Guide, the go-to place for all things finance and investing. Today, we've got an exciting topic lined up that's perfect for beginners looking to dip their toes into the world of financial markets: options trading. But before we dive in, don't forget to hit that subscribe button and ring the notification bell so you never miss out on our upcoming videos. All right, let's get started.
So what exactly are options? Well, think of them as financial instruments that give you the right, but not the obligation, to buy or sell an asset at a predetermined price before a specified expiration date. It might sound complex, but don't worry. We'll break it down step by step. There are two main types of options that we will cover: calls and puts. Calls give you the right to buy an asset, while puts give you the right to sell. It's like having the power to decide whether you want to buy or sell a stock at a certain price in the future.
Before we go any further, let's familiarize ourselves with some key terms. We've got strike price, expiration date, premium. These are the building blocks of options trading. Understanding them is crucial to making informed decisions in the market. Strike price is the price both parties in the options contract agree to buy or sell the stock. Expiration date is the date that the options contract is no longer valid at the end of the trading day. Premium is the payment paid by the buyer to the seller of the option when the contract is opened. Each contract in a call or put option consists of 100 shares of that particular stock or security. Sell to open is the act of selling an options contract to open the contract. Buying to open is the act of buying an options contract to open the contract. Buying to close is the act of buying an open contract that you have previously sold. Selling to close is the act of selling an options contract that you previously bought. Closing a contract means you are no longer obligated by the contract. The premium is the cost of the contract and fluctuates based on if the stock is moving up or down. Let's say you open a contract that costs 5 cents with a strike price of $20. The current stock price is $17. If the stock moves up to $18, the cost of the contract will go up since it's more likely the strike price will be met. Each contract in a call or put option consists of 100 shares of that particular stock or security. So the cost of each contract is 100 times the price shown on the options chain. For example, an option that has a price of 9 cents would cost $9.
Now let's see how options trading works in action. Imagine you're bullish on a stock you think its price will go up. You might consider buying a call option. On the other hand, if you're bearish and expect a stock to drop, buying a put option might be your go-to strategy. Like any investment, options trading comes with its own set of risks and rewards. It's essential to understand them before diving in. We'll discuss how to manage risk and potential strategies to maximize your gains while minimizing losses.
Key details of call options. A call option gives the holder the right to buy a stock at a certain price before the expiration date. From the buyer's perspective, the buyer is bullish, expects the stock to go up, and wants to lock in the ability to buy at a lower price. From the seller's perspective, the seller or writer sells the call option in exchange for a premium, expecting the stock doesn't rise too much so they can keep the premium without having to sell the shares, or the seller does want to sell the stock at that price and would like to make additional profit in the form of the premium collected. It is recommended to only sell call options on stocks and a price that you are okay with selling the stock at. Selling a call option while having the stock is called a covered call. Example of a call option. You buy a call option for Apple with a strike price of $180 and expiration in 30 days. If the stock rises to $200, you can buy the stock at $180, even though it's worth $200 in the market, giving you a $20 per share profit, minus the premium you paid. If Apple stays below $180, the call option expires worthless, and you only lose the premium you paid.
Key details of put options. A put option gives the holder the right to sell a stock at a specific price before the expiration date. Buyer's perspective. The buyer is bearish, expects the stock to go down, and wants the ability to sell at a higher price than the market if needed. Seller's perspective. The seller earns a premium from the buyer and expects the stock price stays higher than the strike price, so they don't have to buy the stock. Or the seller expects the price to drop to a level that the seller feels comfortable to purchase the shares at. It is recommended to only sell put options on stocks and a price that you are okay with owning the stock at. Example of a put option. You buy a put option for Tesla with a strike price of $250 and expiration in 30 days. If the stock falls to $200, you can sell the shares at $250, locking in a $50 per share gain, minus the premium. If Tesla stays above $250, the put option expires worthless, and you only lose the premium you paid.
There are a few more important items to know before trading options, which can help you choose the best stocks for option trading. These are delta, theta, and implied volatility. Delta measures how much the options price will change for every $1 change in the underlying stock's price. Call options. Delta is positive, 0 to +1, because the call's value rises as the stock price increases. Put options. Delta is negative, 0 to -1, because the put's value rises as the stock price falls. Example: if a call option has a delta of 0.6, the options price will increase by 60 cents for every $1 rise in the stock. Key aspects of delta. Delta as a probability. Delta can also represent the probability that the option will expire in the money. In the money is the term used to describe an option that has passed its strike price. This can happen at any time the contract is active, and is possible the contract can be exercised or assigned. Hedge ratio. Delta shows how much stock you would need to hedge. For example, with a delta of 0.5, you'd need to hold 50 shares for every option contract to maintain a neutral position. Theta measures how much the options price decreases per day as it gets closer to expiration, assuming all other factors remain constant. Example: if theta is negative 0.05, the option will lose 5 cents in value every day as expiration approaches. Call and put options. Both calls and puts lose value as time passes, assuming everything else stays the same, meaning theta is negative for both. Key aspects of theta. Effect on short versus long. Options. If you buy options, long calls or puts, theta works against you, value decreases over time. If you sell options, theta works in your favor as you benefit from time decay. The value decreases and you are able to buy your contract back at the price the option is trading at currently. Ideally, this is below the price you originally sold the option for and you pocket the difference. Time decay acceleration. Theta decay is non-linear. It increases sharply in the last few weeks before expiration. Implied volatility, IV, is a key metric in options trading that reflects the market's expectations of how much the price of the underlying asset is likely to fluctuate in the future. It's derived from the options price and represents the expected magnitude of price movements, not the direction.
Buying to close and selling to close. These terms refer to the process of closing out an options position before expiration. You may want to close an options position early to lock in your premium that you have made if you sold an option, to sell your option for more than you paid if you bought an option, or to not be obligated by the contract anymore. Selling to close. When you sell to close, you are closing out an existing long position, an options contract you previously bought. Purpose: lock in profits or cut losses before expiration. Example: you bought a call option for $200. Now it's trading at $400. You sell to close and earn a $200 profit per contract, excluding transaction fees. Buying to close. When you buy to close, you are closing an existing short position, an options contract you previously sold. Purpose: limit losses or capture gains if the sold option's value has decreased. Example: you sold a put option for $300. Now it's trading at $150. You buy to close for $150. securing a $150 profit per contract, excluding fees.
Before we wrap up, here are some quick tips for beginners venturing into options trading. These nuggets of wisdom will help you navigate the markets with confidence and avoid common pitfalls. Practicing with fake money or paper trading is a good idea to learn the process and hone your strategy. Not everyone is the same, and you need to find what stocks and probabilities work for you. You will be assigned contracts if you trade options long enough. It's part of the game. Don't get discouraged. You may want to start by selling options at first to gain an understanding of the process.
And there you have it, folks, a beginner's guide to options trading. Remember, practice makes perfect, so start small, gain experience, and soon you'll be making strategic moves in the financial markets. If you found this video helpful, give it a thumbs up, and don't forget to comment below with any questions or topics you'd like us to cover in future videos. Thanks for tuning in, everyone. See you in the next video. Happy investing!